Hello, and welcome to The Explainer. Today, we're getting right into it. How do you know if a company is actually making money? I mean, really, truly profitable? The answer, well, it's a bit more involved than you might think.
Think about it. You hear all the time that a company had a great quarter, but what does that even mean? How do they prove it? It's not just about having a pile of cash. To show they're profitable, companies have to tell a very specific kind of story.
And yeah, it really is a story. It's got a clear beginning, a middle, and an end. It shows you exactly how much money came in the door, how much went right back out, and this is the most important part, what was actually left over.
That story is told through one of the most critical documents in the business world, the income statement. This is our guide to understanding how a company really performed over a set period of time.
So what is this thing exactly? The income statement, which you'll also hear called the P&L, is kind of like a company's report card for a specific time frame, say a quarter or a whole year. It tracks everything from the very first dollar of sales all the way down to the very last dollar of profit.
And this isn't just about looking in the rearview mirror. For a company's management, this is a vital strategic tool. They use it to figure out what's working and what's not, helping them answer the big questions. Should we push harder to grow sales, or is it time to get serious about cutting costs? Now, it's super important to remember that the income statement is just one chapter of a three-part saga. To get the complete picture of a company's health, you also need the balance sheet and the cash flow statement. But for now, we are laser-focused on this one story, the story of profitability.
So let's take that journey, shall we? We're going to walk, step by step, right down a typical income statement, from that very first number at the top, all the way down to that famous bottom line.
Here's our map. It's a simple four-step path. We start at the top with revenue, and with each step, we subtract a different kind of cost until we're left with the final profit. Ready? Let's do it.
Step 1. Revenue. This is the big one. It's right there at the top of the page, which is why it's famously called the top line. This is all the money a company makes from its core business. So for Apple, it's iPhone sales. For Tesla, it's selling cars.
Okay, from revenue, we make our first big deduction, the cost of goods sold. This is what it costs to directly create the product, like the parts and the factory labor. What's left over is the gross profit, and this is a huge indicator of how efficient a company is at actually making its stuff.
Now we get to what many analysts believe is the realest measure of performance, operating income. We get here by subtracting all the daily costs of just being in business, marketing budgets, R&D, salaries. This number cleanly shows you the profitability of the company's main operations, plain and simple.
And at last, we've made it. We've reached our destination, net income. This is it, the famous bottom line. After you subtract every other expense, we're talking interest on loans, we're talking taxes. This is the final official profit that the company gets to keep.
Okay, that's the theory. It's great, but let's make it real. How does this whole journey actually play out for the biggest, most powerful companies in the world? Let's take a look at some numbers from the giants of the S&P 500.
So here they are, the heavyweights. You can see right away that the top of the US economy is absolutely dominated by tech. But what's so fascinating is that while their size is just mind-blowing, their income statements tell surprisingly different stories about how they get to their profits. Just to help you wrap your head around the scale we're playing with here, consider this. In one single quarter, the chipmaker NVIDIA brought in over $44 billion in revenue. That's the top line. It is just a staggering figure. And here's how that massive top line flows down the statement. NVIDIA kicks things off with that $44 billion in revenue. After paying for what it costs to make the chips, it still has almost $27 billion in gross profit. Then, after paying for R&D and all its operations, it's left with almost $22 billion in operating income. That is the sign of an incredibly profitable core business.
Now, let's pivot to another tech titan, Microsoft. Their business model is a thing of beauty if you love high margins. For every dollar of revenue they make, an incredible 45 cents drops all the way down to operating profit. That's the magic of software and cloud services. They're cheap to sell over and over again.
And now for a completely different universe, look at Walmart. Their operating income is just a tiny sliver, only about 4 cents for every dollar of revenue. So what's their secret? It's the classic, high-volume, low-margin game. Make your money by selling an unbelievable amount of stuff
with just a tiny bit of profit on each sale. Two giants, two completely different financial stories.
All right, for our last section, let's arm you with some tools. Now that you know the structure, here's how you can start to read an income statement like a pro and really understand what's going on between the lines.
Okay, you will almost always see a line called earnings per share, or EPS. But hold on, there are two kinds. The one you really want to watch is diluted EPS. It's the more conservative, more realistic number because it pretends all potential shares, like from employee stock options, have already been handed out. It gives you a much truer sense of the profit for each share.
So here it is, your analyst toolkit. When you're looking at an income statement, remember these rules. 1. Zero in on operating income. That tells you about the health of the core business. 2. Check the quality of the revenue. Is it coming from their main operations? 3. Look at expenses. Is the company investing in growth or just desperately cutting costs? 4. Always use diluted EPS for the more cautious view. And 5. Never, ever analyze the income statement all by itself.
And that leaves us with this final thought. The income statement is brilliant at showing profit, but a company can post a massive net income and still be in serious financial trouble. How is that even possible? It's because profit isn't the same as cash, and that is a story for another explainer.